The second contrast we want to see is between free trade, where price is the world price, and a tariff, where price will be equal to the world price plus some tariff. A tariff is a tax on imports collected by the government. Okay, so what difference does it make if instead of allowing free trade at a world price, the government instead decides to impose a tariff? Let's start out with our original supply and demand curves. And there's the world price. But what if the government decides instead to impose a tariff, T, and say consumers are going to have to pay PW plus some tariff? Well, with free trade, we have seen that consumers will buy QD1, suppliers, US suppliers, I should have labeled these curves, US suppliers will only want to sell QS1 at that low price PW, and the difference between what US suppliers want to sell and American consumers want to buy will be imports. So let's call that M1. That's the difference. Now what if the price is higher? If the price is higher, American consumers will cut back and will only buy QD2 because the higher price will make them cut back. On the other hand, the higher price trade with a tariff. Free trade means no tariff. If we're trading but the government imposes a tariff, then the higher price will encourage American producers to sell more. They'll be willing to produce QS2 if they can charge the higher price PW plus T. That's our new price, P2. Our original price was the world price. So, what's happening? Well, there'll still be imports, but there won't be as many imports. That's the new level of imports. And what else has happened? Well, we see some interesting things. Let's look at label some points here. This trapezoid what's that? Well, that's the increase in producer surplus, because producers are now selling more, QS2 instead of QS1, and charging a higher price. So that's the gain in producer surplus. Consumers have lost this entire box, this trapezoid. That's the fall in consumer surplus, because consumers are now consuming less and paying a higher price for it. But where did that lost consumer surplus go? Some of it was transferred to producers. Some of it has gone to the government. This box, call it T. T is government tariff revenue, and it's the amount of the tariff times the level of imports. Little t is the height of that box, and the width of that box is M2, the amount of imports. M2 units are imported, and every time someone imports one, they have to pay the tariff, little t on it. So the green box is tariff revenue going to the government. Now, that still doesn't account. Some of the lost consumer surplus goes to producers, some of it goes to the government, but we have two things left over. We have these two triangles, triangle number 1 and triangle number 2, and they are deadweight loss. Consumers lose it, producers don't get it, the government doesn't get it. And the way to think about them is triangle 1 is the deadweight loss caused by that increase in domestic output. Those are cars that should not be produced in the United States. The only reason they're being produced in the United States is because of the tariff, the distortion of the world price. And similarly here, these cars that American consumers are not buying but should be buying, why aren't consumers buying them? Why aren't they getting that consumer surplus? It's a deadweight loss due to the distortion effect of the tariff. So, out of all the lost consumer surplus, some goes to producers, the blue trapezoid, some goes to the government, the green square, but triangle 1 and triangle 2 are the deadweight loss effects of a tariff.